Good morning. Welcome to this rundown for global stocks and commodities for the 14th of May. Not a lot changed during the week, so it was still pretty much status quo. The American market remains anchored very near to its all-time highs, and there's really not a lot of sign of the market being sold off despite the time of year. So let's get on and have a look at what happened last week, because there certainly were some interesting moves which really illustrate how markets operate and why most people get it wrong. So with the American stocks, the S&P 500 index eased by 8 points on the week. So it's continued this very tight range now that's been in place for more than a month. But it just feels to me like a clean breakout to the upside is imminent. That's really not a scientific analysis. It's just a gut feeling from decades of watching the market very, very closely. There just doesn't seem to be anything that is going to push this market down other than perhaps some short-term geopolitical issue. And if that were to be the case, then I would expect that the market would just bounce straight back up again, because the fundamentals are certainly solid enough for the market to be at this level or to perhaps even trade at a higher level. The small caps are lagging. So as you know, I look at market breadth quite a lot, and the small caps have lagged a little bit in recent time, but not by a lot. And I just think that's within the overall tolerance of fluctuation. So I'm not concerned about that at this stage. The naysayers, of course, the ones that are trying to talk the market down and that can't find anything good to say about the market, they point to the weak retail sales in the US that we've seen. But, my point would be, what about Amazon? I mean, they're looking at the bricks and mortar stores. They're looking at the old society when you look at weak retail sales through bricks and mortar stores. What about Amazon? And I talked about that last week, and I showed a chart, and I'm just show this chart again for anyone that missed it. Because this is what the new economy is all about. It's what's being sold online. Europe, some more good data out of Europe, both economically for the countries and for the corporates as well. So Europe improving quickly. Just a reminder, here's the chart I showed last week on Amazon. The red line, of course, is important. That's profit. And you can see how from 2012-13, the profit line has just gone absolutely exponential. But equally as important is the light blue line, which is free cash flow. And free cash flow is also rocketing up, and in 2016 sat at $10 billion. So anyone that wants to point a hole in or poke a hole in the Amazons and the Facebooks and the Googles and say that they're wildly overpriced and they're just some sort of accident waiting to happen, then just refer them to this chart, because I think that pretty much says it all. Amazon, of course, is now in a position where they've become an almost unassailable world beater, and in any area that they want to go into, they can just buy their way in. They've got so much free cash flow to do that, and they're going to be making a major assault on the Australian market in all sorts of ways. That's for sure. Right, let's just look at the American stocks. So this is the S&P. You can see the week that we had, the last 5 candles there. It's all extremely tight. If we pan back, you can see we've continued to accelerate away from all-time highs, and there's really no signs of any selling pressure there. I particularly point to the fact that the daily ranges are very small. They're indecisive. There's no kind of series of prices closing on their low of the day, and I will continue to go through this exercise looking at what previous major tops in the market have looked like in 2000, 2008, and we also got a bit of a fright in 2011 and again in 2016, but the market continues to march on, and I'm as I've said many times, I'm just playing the ball as it comes down the pitch. I'm not making any predictions about where the market is going. I'm merely observing and responding accordingly. Just while we're here, let's look at the US dollar, because that's a key component of what's going on around the world. So generally last week we got a bit of a rebound in the US dollar, but there is a short to medium term downtrend in play there. And that's why it's interesting, despite the fact that the US dollar has been falling since mid-April, commodity prices have also come off as well. And that's largely because of the weaker data coming out of China, or as far as the Western media portrays it. So turning now to Aussie stocks, the Aussie dollar sharply lower initially, and then it bounced to just a tick under 74. So it certainly has moved down into that lower band and may over time trade down towards 71 cents. In fact, there are plenty of the major banks and economists who've been pointing towards a 70-cent target by the end of this year. So that's just another reason to have, for the Australians listening to this video, more reason to have some of your money in US stocks. You get a nice currency boost there as well. The ASX 200 index was exactly flat across the week, so really nothing doing. And as you know, the banks are the biggest influence on that index. The banks are in a medium-term uptrend, which we'll have a look at. But if you pan back and take a bigger picture look, the banking index is flat over the last 10 years. There's been no capital gain since 2007. Now, just as an example, because I know that the banks are a favourite of many people, and I don't mean to bash the banks, but in terms of attractiveness, I just don't find them attractive. But I thought I would just go through this exercise, and I looked at the dividends that CBA has produced in that same time since 2007, and they've produced $33.89 in dividends, which on what you would have bought CBA shares for in 2007 represents an 80% return, or 8% a year. It's tidy. And of course, there's been some capital gain there as well. So the banks have actually been quite a sound and solid investment during that period of time. You get no argument from me on that at all. However, the issue is that the environment for the banks, which has been very conducive for the last, in particular, 5 years, where they were able to wind back their provision for bad and doubtful debt, which added to profit, which added to their ability to pay dividends. They had a significant credit expansion going on in the Australian economy, which fed into the housing market. And there are a few other things as well that all added up to tailwinds for the last 5 years. Now, those tailwinds have turned around. The banks now are starting to have to ratchet up their provision for bad and doubtful debts, and they started doing that just in the last week. The housing market in Australia is looking very, very distinctly toppy, and therefore that credit expansion cycle has run its course. Thirdly, you've now got, and this is a phenomenon all around the world, you've now got tighter capital requirements, which means that banks have to preserve more of their funds as Tier 1 capital and have less money to lend out, and therefore that puts pressure on margins and puts pressure on the profits that they can generate. So all the things that have been a tailwind for the banks for years are turning around into headwinds. Now, I'm not saying the banks are suddenly going to fall over, because I don't believe they are. The Australian banks are excellent organisations. But if you expect to get the same return from the Australian banks in the next 5 years that you have in the last 5 years, then I think you're dreaming, because it's a totally different environment. So let's just take a quick look at the Aussie market. So we'll look at the ASX 200, and you can see we're just continuing to struggle in this range between 5,800 and close to 6,000, and not really showing any signs of being able to break it. And this is the banking index, XFJ. And so if we pan back and take a big picture look at this, let's go all the way back to 2007. And if you follow that horizontal line across, you find that in January of 2008 and also in August of 2007, the banking index was trading at this same level of around about 6,500 points. So basically no capital gain in the banks during that period of time as a sector. Yes, they've paid great dividends, but yeah, I just think they're much less attractive these days. And so you've got to, I really encourage everyone watching this video to not get caught up with just staying with what has been the household names and assuming that because they've been good for the last 10 years that they'll continue to be good for the next 10 years because a lot of things are changing very, very quickly. Turning now to precious metals. Gold was down by $1, so effectively unchanged at $12.29. So we remain back below that key 200-day moving average. Now, there was a massive drop in the speculative longs in the futures market in gold. It was the biggest drop in 5 years, and it was very, very substantial. So any excess that was in the gold market has, in the futures gold market, has been well and truly wrung out now. Now, the interesting thing is, and this is really a study in human behavior, is that, of course, the massive drop in speculative longs came just as gold was basically bottoming out and gold stocks have already started turning back up again. So once again, the masses are being caught with their pants down. They're selling at the worst possible time. They're buying at the worst possible time. If you try and trade most markets based on the news or on data, then you're just going to get your head handed to you on a plate time after time after time. You've got to be, it's like a chess game, you've got to be a couple of steps ahead of the market. And that's what the smart money does. It sells out when things are looking good, when sentiment is positive, when the futures market is really buoyant and everyone's pouring into it, and they're buying back when everybody is panicking and selling out. And that's the way you make money in the market. So for me, the gold market, it's a trading vehicle only for the foreseeable future and only at the extremes. I think you should be waiting until there's a decent panic sell-off, and you should be waiting until there's a level of real positivity in the gold market to basically go the other way. So I think that's the only way that you should be trading the gold market. Now, precious metals stocks, the expected strong bounce that I talked about last week, that materialized right on cue, but I remain cautious on the sector. I think there's certainly terrific opportunity, but there's also significant risk there as well. Let's just look at the precious metals market. This was silver. Silver was very buoyant up here. This is when there was basically record highs in speculative longs in silver in the futures market. That was the time to be selling. And of course now we've had a massive liquidation in the selling market. The price has come down from $18.50 down to almost $16. Well and truly oversold. Now started to turn around, and silver stocks have started going up again. And this is the gold market. Similarly, a bit of a tentative turnaround in the gold price, but as you'll see, stocks doing better. So let's look at GDX as a proxy for stocks, and you can see that the stocks really took off 2 or 3 days before the price of silver stopped falling. So that's how the smart money plays it. Moving on to other commodities now. Copper was steady at 252, and all other commodities were pretty harshly dealt with. Certainly iron ore under pressure, and some of the other base metals as well. Crude oil, there was a small recovery to 47.84. And I think on a big picture level, the energy sector is now in the final stages of its downtrend. There's probably a basing pattern that's starting to unfold now, but it's early, it's preliminary, and it may take 6 months or more for that to fully play out. So I would not be going into the energy sector yet. Don't try and catch falling knives, because we might find that there's some cheaper prices yet to come. There's the spot copper chart. And wrapping it all up, the S&P 500, it's threatening a breakout. But again, my gut feeling is it needs to get on with it. If the market holds here for too long, then there will be some people that will get nervous and impatient, and they'll start to sell, and that could well trigger a short-term cascade to the downside. So if the S&P is going to break out, I hope that it can achieve that in the next week or 10 days. Because the longer this very tight band goes on, then the risks rise that we'll get a short-term sellout. Otherwise, there's really no change to what I've been saying now for weeks. You should stay invested. There are no signs of a major market top. You should be looking to add on dips. Definitely don't chase the prices when markets are as close to overbought as they are. Just focus on the best sectors only. I've touched on what those are. Members, of course, know exactly what they are and what the stocks are. I think you should forget about investing or trading the general market. I still get a lot of questions about what indices are doing. I don't pay much attention, to be honest, certainly not in Australia, because you really should be focused on specific sectors and stocks that will do the best. In America, you've only got to look at the incredible disparity between, let's say, the US technology sector and US listed Chinese internet stocks, where the prices are just booming, the earnings performance is booming, and then you go to the other end of the spectrum and you look at something like the auto sector, which is really it's the same thing building up again in the auto sector that happened in the housing market that led to the GFC, and it's just happening all over again. So if you're invested in anything related to the auto industry, then that's an extremely risky investment. So markets are incredibly at incredibly diverse extremes, and you need to make sure that you're zeroing in on the extremes that are going to do well. That's it for this week, and I'll be back with you next weekend with another update. Cheers.